how different indices has performed within India. Because then obviously if you have taken stocks, you might have taken stocks into say some into mid cap, into large caps. You might have stocks, banking stocks with you like HDFC, Kotak, so on and so forth. So then how these sectors have performed and how the volatility had been there. So if you see this graph, you will come to know that here we have taken Nifty 50, which is the main. Here we have taken the mid cap, 150 stocks of Nifty. Here we have taken the bank, and here we have taken the volatility. If you see here, while the volatility was going down, the markets were going up. So here I'm talking about the mid caps were going up. Here the banking was going up. Here you would see the Nifty 50 was going up. When the volatility started going up, the market started falling. You see the green, the volume, the positive volume started diminishing, and then the sell volume happened. So similarly here, so here you were saying the main Nifty had gone down. Now the concern, and same thing happened with the bank. Bank, it happened more. So because we know that there has been a case of Kotak, and then there has been the case of HDFC. We have seen SEBI, RBI after the banking stock. So therefore there have been much risk. So if you see that during the same period, the bank has gone down by -5%. During the same period, if we talk about the mid cap, they had gone down by 4.17%. While during the same period, there has been a 91%. I'm talking about from here. This is 23rd of April. This is the 97% of the volatility. The volatility has gone up by 91%. So we have seen here mid caps falling by around 4.1, then we have banking at -5, and then we have -3.64% main stocks like Nifty. So therefore, we have seen there how the volatility impacted, and the banking had been the worst hit, and then there had been the mid caps, and obviously Nifty being the large cap is much more stable because it has a good FMCG stocks, healthcare, pharma stocks that would have given cushion to it. That is, now when we look into this, then the next concern comes. Okay, we have seen Nifty 50 and indices, but if we see the whole market as such, and over the past 5 days, how the different sectors have been performing. So here if you see that when we're talking about the metals and mining, there is only 1 and 2. So in all those things, if you want to have a stock portfolio that is much more shock proof or resilient, shock proof can't be there, but resilient for that matter, is the FMCG. Because if you see in FMCG, there is 1, there is 2, 3, 4, 5, 6, 7, 8, 9, 11. So you are seeing 11 being in the green. Similarly, if you see here capital goods, so you will see 1, 2, 3, 4, 5, 6, 7, and 8 being in the green. So therefore, if we see FMCG, we have Marico, Imami, Godrej, and all those companies being in the green. You have the Daburs being in the green. In software, there had been only the 2 companies which have been in the green, but otherwise, many of them have been down. Healthcare is one of the factor where you can see Agenta Pharma and Alchem Labs being into the green, and a couple of there among the smaller players. So therefore, if you see about the riskiness that has been there, that it has been 100% risk into infrastructure. There have been 100% risk into telecom. There has been 100% into diversified. There have been 100% into insurance, agri, industrial gas, so oil and gas for that matter. And here, if you talk about the bank, except I believe 1, much of it has already been into the red. So therefore, when the markets have obviously the banking and finance have been there, except a few outliers. So having said that, if you tomorrow say that, okay, I want to have a better portfolio, I want to reduce the risk of the portfolio, so you now know which segments or the sectors are the one which have the stability. So how much you can diversify your portfolio, how much you can have these stable scripts in your portfolio, so that the whole volatility can be brought down into the portfolio. So now, while this had been at a broader level, but if I just want to give you a glimpse, this was an eagle eye view. So if I want to give you a zoom in view, so here comes into the sector performance, and here we have taken 1 metals, here we have taken auto, here we have taken infra, and here we have taken FMCG. So like said, FMCG had been only impacted herein where it has been -2.91%. And in the same period, the infrastructure had been minus 5% over. And auto has been rather positive. Auto had been positive. It has not been negative because the very good sales figures have been coming up because end of the month figures also do come up, and then the results came up. The sector itself was quite a bit. So in case of the metals also, the metals had seen minus 6%. So this is how, and obviously we can go on for sector by sector after that, but this is how you can see. Here you have during the same period when the banking had fallen by 5% and the other sectors by 3.5%, that mean indices, we have an auto which has been up in a positive line. We have an infra and you can say metals that have been actually hit very hard. So FMCG and auto have been better placed in the current scenario.